A very good morning to everyone, to all the participants here. In association with ACVA RVO, we have made this CEP session. So I request everyone as much as possible, please be on video. And as and when the admin does the poll questions, please answer it. The poll report, attendance report, and the registration report goes to IBBI, and accordingly the CEP certificates will be issued. Just an announcement. Bangalore Valuers Association is happy to announce a physical session which is being planned on 3rd August 2024 at Rajaji Nagar, Bangalore Marriott Hotel. We'll be very shortly announcing all the flyers and all, just in the process of finalizing certain speakers and topics. But my request is to please block your calendar on 3rd August 2024. It's a one-day session from morning 9 a.m. to 5 p.m. And the intimations will come shortly. Yeah. Now I request our secretary, Mr. TVS Shiv Prasad, to formally introduce today's speaker.
Good morning, all. I heartily welcome Mr. Vikash Goyal, and I take the privilege of introducing him. Mr. Vikash Goyal heads Valuation group of companies specializing in valuation and talent management. Mr. Vikash is a CA, CFA, MS Finance, and an MBA. He is an alumni of IIM Kolkata and St. Xavier's College. Before Omnifin, he spent over a decade working with organizations like PwC, ICA, and E&Y. Mr. Vikash has authored multiple books on valuation and works with hundreds of startups and scores and listed companies around transaction advisory and valuation. He was recently awarded CA Business Leaders 40 Under 40 by ICA and the CNBC TV 18 for his work around the valuations for startups. I think most of us might have referred or followed his book on valuation for the registered valuer examination. I watched that his best book is the best book, and I gave my feedback to Mr. Vikash Goyal. Once he may remember that is bulky, and I requested him to divide it to two parts. I recommended the book to many of the aspirants for registered valuer examination, and he had given so many MCQs also for preparing for the examination. And also he has authored one book on practical aspects of valuation, which is very useful for the registered valuers who are qualified and who wants to start their practice. I request Mr. Vikash Goyal to take over this session and enlighten us on valuation of complex securities like convertible debentures and preference shares for financial reporting purposes, and ESOPs and non-convertible debentures. I request Mr. Vikash Goyal, with your wide knowledge and acknowledged expertise, please enlighten us, all of you. We are eagerly waiting for your sharing of knowledge. Thank you.
Thank you so
Mr.
much.
Vikash, please cover optionally and fully convertible. This topic was all along expected and awaited by all the participants. So I asked Neela, please do not forget to record the session. I'm going to get request for this.
Thank you. Thank you very much. Good morning, sir. Good morning, ma'am. And thank you for inviting me over. It's a privilege and honor. I know I missed a couple of sessions in the past because of some urgency or the other, so I didn't want to miss this one. And of course, it's a vast topic. So and there are a lot of things which has to be covered in this. We'll try to keep as broad a perspective as possible and try to cover to the best of my ability. Excuse me. I'm going to quickly start my PPT, and we'll take it from there.
You can stop the share. Mr. Vikas, let us know as and when you want the poll to be run.
Okay, sure. We'll try to keep it towards the end. Otherwise, I'd like to keep it interactive. Ask questions verbally, and then people can answer based on raising their hands or in the chat window. I'm
Around
told we
9
can
o'clock, we'll keep
Huh.
for.
We can try to keep it towards the end. Okay. So when we say valuation of, I hope you can see the screen, right?
Yes.
Yeah.
Yes. Okay. Yeah. Thank you. So when we talk about complex securities, of course, it's a subjective term, right? I mean, it could be something could be complex for you, simple for me. Something could be simple for me. Sorry, complex for me, simple for you, right? So there's no such definition of a complex security, right? It's a relative term, and the kind of world that we are in now, and the kind of world that we are becoming, especially in India, right? I'm sure this is going to continue to evolve in the times to come. I mean, I remember when I started my career with PwC, we used to work very closely with a lot of global asset management companies, and it's been 17 years since then, and some of the terms that I heard way back in 2006, 7, 8, 9, we haven't heard those terms in India even till date, right? So so how do we kind of look at those complex terms? So there's no definition, right? So when we talk about simple securities, we can talk of securities like an equity share, a non-convertible debenture, a compulsorily convertible debenture, a redeemable preference shares, and so on, right? Now again, see, when we say simple securities, I'm sure for the fraternity, for the audience today, these are all simple terms. 2 days before, I was speaking to a set of professionals who were qualified finance professionals, but I was only talking about equity securities, and that too a very, very brief basic session, and it was they found it to be extremely complex, right? So, like I said, it's a relative term. When we talk about complex securities, again, there's so many of them, so many of them. Um, so and as we speak, right? I mean, it keeps on evolving, like I said. So we can talk about optionally convertible debenture, optionally convertible preference shares, compulsorily convertible preference shares, which has got varying rights and conditions. We talk about different types of derivatives, right? Especially the ones which are traded over the counter and not on a stock exchange, right? Those are fairly complex securities. Just 2 days back, we have started one engagement where we have started valuing a structured note, right? And that structured note is going to derive its value from three underlying macroeconomic parameters. It is going to derive value from the employment data, the GDP data, as well as the inflation data, right? From that, there's an index which is getting constructed. From that index, the value is going to come in, right? And we have to look at the pricing of the index. It gets reset on a daily basis. So it's fairly complex, right? So we, of course, we can't cover all of those. I'll try to cover a few things, but it's very important to understand the context in which that valuation will be done, right? So when I talk about complex securities, any securities for that matter, let as registered valuers, everyone here is a registered valuer, right? So when we talk about valuation of complex securities, the context is very important. Why are we valuing it in the first place? Okay. So when we are valuing a security, can someone tell us, let's keep it a little interactive, what are the context in which you're valuing, the purposes of valuation, right? Can you use the chat window and let me know what kind of purposes are we having to value securities in general, given the context of our session today, right?
Mr. Vikas, here I would like to clarify that
Mhm.
whenever any this optionally convertible instruments are being issued, this valuation is not required, what we are discussing, right? This is at the time for Indias and all of this, not exactly at the time of issue under Section 247.
No, so
It's
yeah,
rather
so
62.
it would be required, right? So again, it depends on what kind of company we are valuing. So if it's a company which is a large organization and is subjected to Ind AS, all kinds of complications come in. If it's a simple organization which is following Indian GAAP, the process could be different, right? So when we are taking the
Even at the
context,
time of issue of securities?
yes, certainly, right? So we are saying that majority of these valuations would be required at the time of issue of securities. Okay. So yes, please continue to use the chat window and respond what kind of purposes we are talking about when we are valuing complex securities.
Because good morning. Can I
Good
respond?
morning, sir. Yeah, please, sir. How are you?
Fine. So normally plain vanilla is equity for further issue of shares.
Mm-hmm.
Coming to the complex securities means where we got some redeemable preference shares, then we need to value for India's recognition purpose. As Shilpa was telling, we got optional convertible instruments, whether we have to value every year or only at the time of issue and redemption. That is one we have challenge. And
Yes.
second thing, recently the convertible instruments.
Right, absolutely.
Security notes.
Mm-hmm.
So these are the documents we're looking. So that when we say CCD, convertible instrument means convertible debentures, convertible preference shares, either compulsory or optionally. This what where I come across.
Right, correct. So those are type of securities. What we are also asking you, and in the chat window, and some people are responding there, is the context, right? So we might have to do these valuations in case of an M&A. So let's say, for example, right, when we are doing a valuation under mergers and acquisitions, normally what happens, if the company is acquiring another company, you have a target company, right? So the acquirer will have to issue a consideration to the shareholders of the target company. Now that consideration could be in the form of cash, where we are simply looking at the valuation of business, not a complication. If the compensation is in the form of shares, again, you are looking at valuing two companies, both the target as well as the acquirer. And here you will have to value both the companies. But again, we are normally looking at valuation of equity shares only. Now, let's say this merger or this acquisition says that the founder of the target company is entitled to a contingent consideration, right? They say that, okay, 90% of the consideration would be paid now, but 10% of the consideration would be paid subject to the company meeting certain profit targets. Because the founder of the target company would have said that these are my business projections, this is going to be my business profit, this is going to be my business revenue, and so on and so forth. So the acquirer says that, okay, you have made these promises. We believe what you are trying to say, but such percentage of your purchase consideration would be paid after 1 year or 2 years or 3 years or 4 years, right? So in that case, what is happening? We are trying to build one contingent consideration in the form of a option, right? So these options would be dependent on achieving or non-achieving of a certain target, and therefore you will have to start looking at valuing a derivative in this case. Needless to say that it is always possible that when you are valuing the target company would already have certain securities which were issued by the target company itself. Some of those issues might have to be reset. For example, let's say the target company had already issued an optionally convertible debenture or a compulsorily convertible debenture. Now, in those cases, normally what happens? The acquirer might feel that, okay, we might reissue the same securities at the same terms and conditions from our side, because since the target company would become the company of the acquirer, right? And let's say if it's a merger and not an acquisition, then what happens? The target company will cease to exist. So what will happen to those securities which were issued by the target company? So the acquirer might say that, okay, or the transferee company for that matter would say that, okay, we will issue the same securities at the same terms and conditions, but those will be issued by us because, of course, the existing securities will cease to exist. Alternatively, they might say that we will settle all of these securities today as if they are converted today. Okay. And we will issue equity shares against that because we don't want any further complication in our capital structure. So absolutely right. For those of you who are saying that mergers and acquisitions is a context in which that valuation has to be done, right? You will have to value complex securities depending on the structure. So again, understanding the structure is very, very important. Understanding the purpose is also very important. The first answer that I had received, the first answer that I had received was for Ind AS purposes, right? Of valuation of equity shares, of funding, right? So section 42, 62, M&A, demerger, capital reduction. Now see, when I hear about these sections, right? Section 42, 62, etc. What happens when you are issuing a security? So for example, yesterday I had a case where a company says that we are issuing compulsorily convertible debenture. Okay, we are talking about a convertible security. We are saying that the company is going to issue a compulsorily convertible debenture. This is a company which is a new company, and therefore it is not subjected to Ind AS because it does not have so much of revenue. Now, when you have a compulsorily convertible debenture being issued by an Indian company which is not subjected to Ind AS, what kind of valuation would be required? I mean, would you really require to value the equity shares of the company? Can someone have an indication around it?
I think so. Equity shares are only to be valued
Okay, why?
because the company is totally new, and
Mm-hmm.
if the terms are not really very complex,
Mm-hmm.
then it will have the same value as equity.
Okay. Now I give you two situations, ma'am. Right. Let's try to tweak that situation a little bit. I am saying that I am going to issue a compulsorily convertible debenture, and the conversion terms, I mean the conversion ratio of that compulsorily convertible debenture would be decided at the time of conversion, which will be at least 3 years from now or any time after 3 years from now. Okay. I'll repeat.
Right.
I'm an Indian company not subjected to Ind AS. I am issuing compulsorily convertible debenture. These debentures will be converted into equity shares mandatorily, but the conversion ratio would be decided at the time of conversion, not at the time of issuance. Now, do I need to value the equity shares of the company at all?
No,
So when the securities are
because now your
convertible
CCD, okay, sorry,
at a later
please.
point of time, then the section 62 allows us to value the securities at the point of conversion. So it's not mandatory to value the securities at the time of issue.
Correct. Okay. Yes. But I think there was somebody else. Pradeep ji, I think you was also trying to answer. Sir, go ahead.
So in this situation, because what I understand is when whatever valuation I have done, like this was one of my scenario also, and I was doing a valuation. At that time also, I told you are not required to supposed to do any valuation. But there is one practical difficulty because which we faced in this valuation is when we are filing the ROC forms. So when the company secretary is filing the ROC form NGT 14 and PAS 3,
Yes.
at that time they require certain valuation.
Right.
What I told them is, boss, you can do it at a face value. You can keep a face value of 10 rupees, 100 rupees, 1000 rupees, whatever you want.
Right.
So on that basis, we have done it because practically to make that ROC people understand that you don't need any valuation is a
Right.
difficult task.
Absolutely. Now, again, see, okay, so
Here
explaining
I
the
would like
ROC people
to,
is one thing.
There's one more point. Yeah.
Yes, ma'am. Go ahead, ma'am.
Yeah, like suppose if it's a issue to the foreign shareholders for FEMA, then even if it's a convertible instrument, CCD, you need to value at the time of issue also.
Ma'am. So, okay, see, forget about FEMA, even otherwise. Okay, sorry, there was another lady, ma'am. You were also trying to say something?
yeah, actually, what I would like to present here is, suppose the conversion terms or that it will be converted much later point of time, just this clause is fine. But then it also continues saying that it will go ahead and have a discount at the future price, which is actually contradicting with the Companies Act. Whatever is the valuation, that should be the price of conversion. But many a times when you are giving the money, the value of the company is increasing because of the money or funds you have given. So it's quite logical that it will be at a discount for the next round. Normally,
Okay.
this is
So,
how it is.
irrespective of that situation, ma'am. Okay, I get your point,
At
right?
that time, it is mandatory to value now because we can say this is the base valuation, that is a future valuation. What 62(1) says comprehending is the conversion should not be higher than lower than valuation, which is this base valuation will be used, the current one, not the future one.
Great point, ma'am. But think about it. When we are talking about a compulsorily convertible debenture where the conversion ratio is not fixed now, is 62(1) is section 62 even applicable? Because
Because we cannot
62
apply
is
it at
talking
a
about
later
preferential
valuation.
allotment of shares, no? So 62 is not will not be applicable to my understanding. We are definitely I think when Pradeep ji mentioned, right, that it might be difficult to explain the ROC people, or I think Jivika ji was mentioning about FEMA requirements. Think of section 42 also, right? Section 42 is talking about private placement. Okay, so majority, I think I'm not a company law expert, and pardon me for that, but what my understanding is that the requirement to file a valuation report is coming from section 42 and 71 in this case, where we have to refer to the 71 is talking about debentures, if I'm not wrong, right? So there, when we are talking about an Indian company not subjected to Ind AS, conversion ratio not fixed now, You simply need a fair value, simply need a face value valuation report for which the valuation of the company would not be required now. Okay. Now, there are a lot of times when understanding of these terms or even the conditions of the issue is not very clear. So I was constantly telling them that, sir, you don't need the valuation of equity right now. Why are you getting the equity valued? Right? Ultimately, we ended up speaking to their legal team, and the legal team said that, Vikash, the conversion would be done at the time of conversion. However, there is a floor attached to it which says that at the time of conversion, if the equity value is lower than today's value, which I think what Shilpa ma'am was just trying to say here, if your equity value is lower than the current value, then you will convert at the floor value. If it is higher, then you will value at the time of, then you will value the security at a value at the time of conversion. Are you getting my point here, everybody? Because it's not on the slide, I just want to ensure that
No,
I'm
no,
being very clear.
no, no,
No,
Vikash,
I'll
you have
explain
to
again.
again speak. Yes.
I'll
Because here
explain
there are
again.
twin conditions, correct? Now you are talking
Ha.
about the second condition.
Yes. Now I'm
Then
talking about
valuation
the
comes
second
into play.
condition.
Yeah,
Ha.
I
So
agree.
what is
Then
happening
valuation
here? They are saying that it is CCD. Okay. The conversion will be at the time of conversion. The valuation would be at the time of conversion. Okay. So when it says that the value would be on the time of conversion or the conversion ratio would be at the time of conversion, then you don't need a valuation of the equity now. But then they said that when the investors are coming in, they are keeping a floor. There is a floor,
Mm.
right? That it
Yeah.
is today value, that is 0, or value n, whichever is higher. I'm sorry, I just have to scribble this. Not sure how to explain this otherwise, right?
But
So
what this
now,
condition is, what this condition is that investors are putting forth?
so again, what I'm saying, the investors are saying that we will convert it on the value at the time of conversion, provided that value is higher than today's value.
Okay, so that is the reason why it becomes necessary to find out today's value.
Yes. Now this value may not be recorded, may not be filed with the regulators, because with the regulators this valuation is not applicable. But see, what they did was they made a very simple debenture, a convertible debenture, a complex debenture, and they have added one condition to it, and based on that one condition, an additional valuation report is also required. And now you would have to value that equity share today. Now, still now, if you just look at it, right? See, so practically speaking, there is no complication with respect to the CCD itself, right? Because we are simply saying that, okay, we have to have a conversion ratio. You compare the value of the security today. You compare the value of the security at the time of conversion. Whichever is higher, you convert at that value, right? And it is as simple as it is supposed to be. There is no need for any other complication on this right now.
It means that if there is option for a conversion price higher of the two, we need to do
So
equity.
there's no option, sir. There is no option. It's
Okay,
not that there
condition.
is an option, and
Condition.
we actually should. In fact, during this session, we will come across. In fact, I have certain perspectives, right? And one of my perspective is that we are actually overrating the concept of options, especially in the private space, including the regulators. And I'm trying my bit to explain to them that let us not overrate the options. Let us not unnecessarily complicate the whole concept, right? Majority of these cases, so we do valuation across the transactions, right? From the time the company has started, from the time the company is doing fundraising, to fair value measurement, to mergers and acquisitions, to purchase price allocation, to insolvency. Look at the lifetime, right? And when you look at the valuation across all of these transactions, you will realize that ultimately, at any given particular transaction, we are unnecessarily complicating it. We don't need to do it. So here what we said, okay, we'll value the equity share, keep that equity share value in your record. There is no need to account for the option. There's no need to value the options. At the time of conversion, just compare the value, convert. Period. That's it. Nothing else is required. Are we all okay with this?
Mr. Vikas, I have a question.
Yes, sir.
You
So
just
call me
mentioned, and
Vikash.
Mr.
Mr. की जरूरत नहीं. It's
So,
fine. Yes.
no issues. So,
Hmm.
so my question is related to Mr. Pradeep has said I mean, rightly mentioned that we, to comply with the ROC thing. So I'm little digressing the issue, but related to valuation only. So, when we, going to comply with the ROC, so do we really need to issue a valuation report with the face value, really, or we can, take a management, valuation on the face value? So, in case of CCD itself.
So, sir, see, so I definitely believe that we should not do valuation where it is not required. But here the law says that it is required. And representing the valuation fraternity, why should I say that no, you don't take a report? You take a simple report. You don't have to charge them ₹1,00,000 for
Sumit
this.
ji, you can take a face value ka report
Huh.
because ROC is very adamant. They are saying that we need a report to approve the form.
I agree.
Otherwise, we will send a query.
I agree. So my next question related to this is, so having said that, I need not value the, the CCD right now at the time of issuance, and only it is required at the time of conversion.
Yeah,
And having
yes,
said that,
yes, absolutely.
yeah. So fine. So how, as a valuer, I will arrive at the face value, because I have to apply, all the valuation standards, and I'm bound to follow those standards. So what I will mention in the valuation report arriving at the face value.
Okay, sir. So look at the terms, right? So when we say arriving at the face value, you tell me, sir, do you think that the face value can be arrived at all, or do you think it cannot be arrived at?
I mean, I have to give the justification why I'm taking, the face value as the valuation at the time of issuance.
So because it's a compulsorily convertible debenture where a future exchange ratio, where a future conversion ratio is not decided upfront.
Right.
What happens is whenever there's a convertibility attached to it, there are some regulations, including FIMDA, SEBI, etc., which says that you split the convertible bond or a convertible security into two parts. One is as if it is not, it is a non-convertible debenture, and second is the convertibility option separately. Now here there is no option as such, correct? But here what we do is you assume, because see, the CCD would be subjected to a, what should I say, a coupon rate, right? Now here you have, when you look at the terms of the security, invariably you will find that CCDs normally do not come with a coupon rate. Okay. But
normally,
let's say, and that coupon rate could be as low as 0.01%, etc. Okay.
Right. For the sake of compliance, right? For
the sake of compliance. Now, so basic bond concepts, and it will tell you that if the coupon rate is aligned with the yield to maturity, the issue price and the redemption price will be the face value. Is that right?
So considering the same, I mean, so if we take the same YTM, then
no, I have to finish that, sir. Sorry, right? So is that part okay? That if the coupon rate and the YTM is the same, then your issue price and the redemption price would be face value. Correct. Now here the coupon rate is 0.01%, which cannot be the YTM. Yes or no?
Yes.
It cannot be the YTM, right? Because any rational investor will not invest into a security which does not give them any return. Yes. So you actually so again, see, there are two situations here. One is that you are looking at a report only from a compliance perspective. The board has decided that it is going to be issued at face value, and it will not be converted. It will be converted only at the time of conversion. I'm repeating these terms, I'm sorry, again and again, just for better clarity with everybody.
Yes.
But what if this was not convertible? You would have to actually calculate a yield to maturity. And that is where the valuer's concept or the valuer's requirement comes in. It's an implicit requirement, but you calculate a yield to maturity and say that, let's say the YTM comes at 9%. Okay.
Right.
Let's say the YTM comes at 9%. So you say that if it was considering that this is a non-convertible bond, I have calculated a yield. If it has to be redeemed, it will be redeemed at 9%. But since the board has decided to issue the share at face value, the face value is the same as the fair value. And you also mentioned that this is for compliance purposes. Ganesh sir, please go ahead, sir.
Okay. So, so I'm not sure whether we can say that.
So I'm saying if you had to justify, sir, right? Right now, from a valuation, what should I say? From a conceptual standpoint, a valuation report is definitely not required here. But what do you do when there is a requirement of the law that you need a piece of paper?
No, I understand that perspective, definitely. So
frankly speaking, I don't do this exercise. If it is required, we simply say that it is a convertible debenture, right? The conversion ratio is not fixed. The board has decided on a face value of 10, right?
Mm-hmm.
Assuming that the conversion will happen at fair value, the face value is the same as the fair value today. And that's all right. The regulators are okay with that kind of a report.
So
what do
Sumit ji,
you
here we need
tell
to
that?
write. So
Sorry.
basically, you need to write on the report that there are no valuation methods would be applicable.
Yes,
So in
yes.
this report, there are
Exactly.
three
So,
methods
yeah.
which are, you need to write that. So
Yes,
neither
yes.
cost approach,
Okay.
nor market approach, nor income approach
Right.
can be followed. And due
Right.
to this, the value has been arrived, what the board has been decided. So face value can be 10, 100, 1,000.
Exactly. And similar situation arises when we are having, so for example, the law is also very clear that, let's say, when there is an acquisition of your subsidiary, let's say when a holding company is acquiring a subsidiary company, a wholly owned subsidiary company, then what happens in the case of acquisition, when the 100% holding company is acquiring its subsidiary company, there is no change in the shareholding pattern, so there is no need for a valuation exercise. But we have issued at least 5 to 7 reports where the consultants, the company, the legal experts said that, sir, no valuation report de dijiye, right?
Right.
And we've
Right.
issued a one-pager report saying that it's a wholly owned subsidiary. Practically, there is no change in the shareholding pattern, right? And therefore, a valuation is not applicable. However,
Right.
so therefore, this is a no valuation report that we are giving. The board has decided on any share exchange ratio, and that will be considered as fair share exchange ratio.
So it's just
So
a piece of
because
paper
in
for the
this
sake of
case,
compliance.
Exactly. So I think so in the context of our discussion in today's session, I think we will try to focus more on some of the technical aspects,
Sure.
right? This is more of a compliance thing, but I hope as
Yeah.
long as everyone's on board, we can move on.
Vikash, I have
Yeah,
one
sure.
question.
Thank you.
Yes, Sheetalji, go ahead.
What kind of what do you write in base of value or premise of value in such kind of report?
Fair value, ma'am. See again. See, as Ganesh sir, please go ahead. I'll just finish this sentence, and I asked you to speak earlier also, right? As in the see, as opposed to a lot of other, and I'm just saying this. I mean, it might sound a little controversial, but as opposed to some of the other larger firms, right? We have often seen that they go by those commas and full stops ki ye rate kaise aaya. So we've had situation ki your beta is 1.3, my beta is 1.09, but your additional risk premium is lower, my additional risk premium is higher. I mean, come on, what are you looking at, right? We have to look at the ultimate fair discount rate. Similarly, we are talking about the fairness of the situation, right? So in this case, if the company is issuing the security at face value and it will be converting the security at fair value at the time of conversion, it's fair, right? So the basis and premise of value would be fair value and going concern. There's no doubt to my mind around it. Ganesh sir, please go ahead, sir.
Thank you, sir. I think that's why a question I was asking, why face value. So what I typically tend to look at this is, suppose if it gets converted after 4 years, at that time value the conversion. So I value actually after 4 years, as on that day. I get a value. I have a compulsory convertible debentures with all the risks associated. I have calculated as on that date. Now, once I decide the value with whatever risk elements involved, that is the amount that I'm going to get it after 4 years. So it's as good as me. I have given money to someone. After 4 years, I'm going to get this much money back. Today, till that point of time, what is the risk involved for me is what I look at it, which is essentially a credit risk in the person. What kind of risk I have, I start looking at data. It's not the traditional discount rate. And that I do currently to today's discount to determine today's value. A compulsory convertible debentures where conversion ratios are certain, but after a point of time, then you value at that point of time. Once you get a value at that point of time, from that point till now, for example, it's only after 1 year, if it's after 3 years, only the time that matters. What is it that you are going to get today is what we are going to look at it. Not the traditional cost of equity then, because it's largely a credit risk there. And the credit risk is essentially because when you have all the risks you have taken care of at that point of time. Now it's only a credit risk from now till that point of time. You discount with that risk, you get today's value. And that is reasonably a fair value of a CCD in today's terms. Now, from a compliance perspective, valuation report perspective, ROC, I am not familiar. I've never been familiar with all those. But for a value that you want to record from a fair value perspective of CCD, I would look at this method. Not a face value straight on, unless it comes below face value today.
Okay. So I have two small questions, sir, here. One, in those cases, do you normally reach at the face value of the security as your fair value?
That's why I said,
Mathematically?
no. It need
You
not
don't.
be at all.
Okay.
It need not be at all.
So
But
here
I'll give
I
an
have.
example. I'll give an example to you.
Go ahead, sir.
Assuming that there's a Tata Motors has issued CCDs. Hypothetically. Now Tata Motors has issued CCD compulsory converter after 4 years. Great electric vehicles, everything is there. So after 4 years, when I look at that particular value of the entity, after 4 years, the value is say 10 times of the face value. For example, it's at a premium after 4 years, right? From the fourth year to today, I cannot discount it to the face value, right? The value is there in that entity. Therefore, there is no certainty that I get as face value today just because CCD is converted after a point of time. If it comes by applying the risks associated, I'm fair with it. If it goes below fair value, I say it's fair. That's how I look at it. See, essentially, I try to break the risks associated. Now, how much percentage of risk return that I need to add onto that? Let's take the example, since you use the word IBC, NRRA. What is NRRA? There's not readily recoverable asset. So it's a future asset. Some value someone would ascertain when we don't know, and they try to discount it today and determine what should be the value. They start putting the risk today. So the only difference between the traditional method and this method in the CCD is the risks have shifted limited to the credit risk or any other credit. We need to look at those elements that some other risks come into picture and then discount with that. I look at that.
Point. Fair point, sir. So happy to, we're okay to agree to disagree kind of a situation here. I have so without further discussing this and going into too much of depth around it, when I'm talking about a compulsorily convertible debenture, my relative credit risk is lower because then I have no obligation to pay cash. It has to be converted into equity, and anybody who's buying a compulsorily convertible debenture agrees to bear that risk because the holder, ultimately is looking at participating into equity value and is not looking at a redemption of cash. Number one. Number two, fundamentally speaking, and we do get some queries sometimes that, Vikash, can you value my securities 3 years from now? I don't know. I'm sure it's written somewhere, which I don't recall, but in my understanding, you cannot conclude on a future value of any asset. You can always estimate the future cash flows, etc. But for me to value an asset on any particular date, so for example, I can value an asset in 1985 sitting today, but I cannot value an asset as of 31st March 2025 sitting today, because when I'm valuing on the date of valuation, I need certain assets which exists. And so I think that's where there's a little bit of gap, but happy to hear what you said. And yeah, so that's definitely an insight. Okay. So let's do something. Let's continue with what I was initially trying to address. We're talking about financial instruments, right? In the context of valuation of complex securities, it's very important to understand the definitions that are there in Ind AS 32, because that guides us a lot around how do we value the securities. Okay. So Ind AS 32 defines financial instruments. Any financial instrument can be classified into equity, financial liability, financial asset. Honestly speaking, even in the context of companies where Ind AS is not applicable, where we try to assess the fairness of a security, we do refer back to financial instrument. Okay. For example, we have situations where a company, and I'm talking about a Fortune 500 company here. Okay. I'm talking about one of India's top 20 companies. And there was thousands of crores of transaction. And somehow the board felt that we can issue a preference share where we will issue it at par and redeem it at par, right, after 5 years. And it would have been built into the term sheet, right? Issue at par, redeem at par at the option of the issuer, right? It took us a lot of effort. They said that this company has done it, that company has done it. I said, sir, we cannot do it. You cannot have a situation where you will issue a preference share at par and you will redeem that preference shares at par at a future date. It is not allowed. Okay. They said, no, this company has done it, that company has done it. Ultimately, 15 days later, they agreed that no, of course you are right. I mean, and to me it was very, very obvious, right? You cannot have that situation. Even if somebody says that a person is willing to participate into the risk, etc., there is no such participation that is practical. Okay.
Because is it not
Even in
permitted?
case, yes, sir, please go ahead.
Issue RPS issued par redemption par.
No, it's not. RPS, correct. Yes.
RPS, is it not possible?
Sir, you tell me, why would it be possible?
9% coupon rate.
Huh?
9%. 9%.
Yeah. So sorry, I should have mentioned that. Thank you for pointing that out. So no coupon rate, sir. It was very nominal coupon rate. Huh?
What is the coupon? So what I'm saying is 9% coupon rate issued par.
Then it's possible. Yes. Then
So
it's
you are saying
possible.
coupon rate is nil, is it?
Yes. So that coupon rate has to be same as the YTM. I'll take a couple of examples around that.
But
Yeah, I should have
case,
mentioned that. Sorry.
in your
Yes.
case, coupon rate is nil, is it?
Sorry.
In your case, coupon rate is nil, is it? 0%.
It was nil. Yes.
Then
yes.
there is no like why he has to.
It was nil. Yes. That's what I should have mentioned that. Thank you. Right. So majority of the valuation issues are resolved if we are applying the Ind AS appropriately. So basically, let's quickly run through what a financial instrument is. So it could be a financial asset of one entity, it could be financial liability or equity instrument of another entity. Okay. Now, financial assets here, it could be a cash, it could be an equity instrument of another entity. It could be a contractual right that receives cash or another financial asset from another entity, or exchange financial assets or financial liabilities of another entity under potentially favorable conditions. And again, there are examples of what that favorable condition is. And then it also says that certain contracts which are settled in entities' own equity, right? That's a financial asset. Now, as a valuer, valuing financial assets in this context is relatively easier. Okay. Now, these financial assets would normally be valued after the company has invested into them, normally, right? So, for example, when you look at Ind AS 113 fair value measurement or impairment, that's where the financial asset valuations normally come in. At the time of investment, the companies usually go with a transaction price, and that transaction price is usually taken as a given. Okay. These are quick examples. So investment in equity shares, investment in bonds and debentures, loans and receivables, deposits given, trade receivables, right? Inventories, PP&E, prepaid expenses. Now I don't know, the world is still divided because inventory is still classified as a financial asset in many cases, right? But there is no contractual right to receive the cash or another financial asset. So therefore, there's still some people saying that inventory is not a financial asset. So we don't go into that debate at this point. Okay. This is where majority of our discussion will stay today, right? Which is a financial liability, right? Again, a contractual obligation to deliver cash or another financial asset or exchange instruments under potentially unfavorable conditions, and certain contracts settled in entities' own equity, right? Now here there are some examples which are given where it says that a puttable instrument would be an equity, and so on and so forth. Okay, we'll take a couple of examples. We don't deep dive into Ind AS, but my sincere request to all my fellow valuers that reference to Ind AS 32, reference to Ind AS 109 would often help us in valuing complex securities, right? More often than not, it will help us. Example, finance lease is a financial liability. Income taxes is not a financial instrument. Warranty obligations, not a financial instrument. Compulsorily convertible redeemable shares, compulsorily redeemable preference shares, financial liability. Financial guarantee. Now, again, this is another area where we are getting a lot of opportunities. Has anyone done a financial guarantee valuation here?
So I was supposed to do it, but it is on hold. It's a corporate guarantee valuation.
Yes. Okay. So a lot of opportunities coming around financial guarantees now, right? Trade payables and deposits. Again, we are also getting a lot of opportunities where, for example, fintech companies, right? When they have given loans to the others. So there are opportunities where lending companies want to sell off a part of their portfolio, and that portfolio needs to be valued because it will be probably, let's say, sold to an ARC, right? So those are also that's a financial asset for the company which is going to sell it. But again, similarly, financial guarantee is a potential liability. right? So earlier it was not appearing in the books of accounts at all. Now under Ind AS, it has to be seen whether it's financial, whether it's a contingent liability or an actual liability, and accordingly it has to be taken into account. So therefore, that's an area where we do have a lot of valuation opportunities. Okay. Finally, we talk about equity instrument,
Can I,
right? So this is,
because
sir, go ahead.
income tax, why it is not a financial instrument where we don't require valuation?
So
Or
it's a liability, but it says it's no contractual obligation. Again, that's what the standard says. Again, see, we don't, and from a valuation perspective, it's not relevant. So it says, even if it's a statutory liability, it is not classified as a financial liability. So again, I mean,
because in
I found it to be a little interesting. That's why I put it here. I'm not sure if
because all
so
the carry
inventories and
forward
income
losses
taxes were
tax.
two interesting things for me here.
Sorry. Go ahead, sir.
Go ahead,
Yes.
sir.
No, all the carry forward losses, everything, there are enough number of mergers and acquisitions does value this entire income tax part of it. And warrants, invariably, if there are there under the obligations of the company in mergers and acquisitions, it does get valued. So I'm from that reason I was asking.
But so warrants, definitely it is. I mentioned about warranty obligations here.
Acha, I'm sorry. Okay, yeah, sorry. My bad then. My bad.
Warrants, definitely yes. And then warrants is normally valued using options. So we treat it as an option, right? Now, equity instruments, again, it's a contract that evidences residual interest in the assets. Examples is preference shares, equity shares, warrants, written call options to issue fixed number of equity shares for a fixed price, and so on and so forth. Okay. Now, here there are some examples where, and this slide will probably help us understand more about an optionally convertible security, right? So a contract is not an equity instrument solely because it may result in the entity's own equity instrument, right? And I think, of course, I'll be sharing this PPT, but this is the slide which you should be looking forward to, right? So it is an equity instrument, sorry, a financial instrument would be a financial liability when there is a contractual obligation to deliver cash or other financial asset to exchange financial assets under potentially unfavorable condition. We already said that. Now here, this is the key part, right? There is a non-derivative contract to deliver a variable number of own equity instruments. So whenever there is a variability in the number of equity instruments that has to be delivered, now when I say variability means it is not fixed today, then it becomes a financial liability, right? Similarly, it says there is a derivative that will or may be settled other than by issuing a fixed number of own equity instruments. So again, when you say other than by issuing a fixed number of own equity instruments, we are still talking about variable equity instruments. So whenever there is a variability, whenever we are not sure how much money will have to be paid or how much equity instruments will have to be paid at the time of issue, it becomes a financial liability. Okay. The moment we fix on the number of issues, again, it is one thing to fix a formula, and it is the other thing to fix a ratio. The ratio has to be fixed. The formula will not help us, right? Can we determine how many equity instruments have to be given? If yes, today, then it becomes an equity. If no, then it becomes a liability. Okay. So again, when it will be an equity, when there is a non-derivative contract or to deliver or be required to deliver a fixed number of own equity, and there is a derivative contract that will be settled in again fixed number of own equity instruments. So I think this is the key part. Every time, whether we are talking about optionally convertible debenture, preference share, compulsorily convertible debenture, preference shares, this is the thing that we have to look at. Most cases. Okay.
Hello, Vikas sir.
Yes. Yes, sir.
Sorry, sir. Actually, my mic was not working. So I have a question in a previous slide, sir, regarding the financial guarantee. Sir, this I want to know. There has been recent amendment in GST. Then the company needs to pay the GST on a corporate guarantee given, right? So can we build an opportunity around this regarding the valuing corporate
100%.
guarantee? That is what. Yeah. Okay.
100%.
Okay.
So financial guarantee or corporate guarantee is an opportunity for valuers because of Ind AS and GST requirements. In fact, Ind AS has been around for a very long time, but nobody was worried about it.
Correct.
Right?
Yeah, but
Now, only
the
because
GST come, yes,
GST has
GST
also
come.
included it, is the company started worrying about it. Because earlier, even the auditors were not worried about it. ठीक है, चल रहा है, चलने दो. But अभी GST देना है, So easily
Correct,
it's become a good opportunity for us.
correct. So only thing I think we have to see the GST requirement if I all is there for the valuation purpose,
You
right?
can see as a valuer, we don't have to worry about the GST requirement, right? It's an opportunity for us. The GST regulations do not impact your valuation as such.
Thank you, sir. Thank you.
Derivative instrument, everybody understands it. So I'm sure everyone understands what is a derivative. So I think there's no point in talking about that. Let's take a couple of examples. There's an error in the previous slide also. So a company buys products from a vendor and agrees to deliver 10,000 shares in the settlement of obligation. Is it an equity or a liability?
Equity.
Equity.
Let's use the chat window. Let us get more answers. This is a CPE session, I am told. So usually in questions like this, after some point, everyone just says, let's go with the consensus. Okay. Now see here, the number of shares is fixed, right? Even if I'm buying a product, the number of shares is fixed in settlement of the obligation. So it becomes an equity instrument. Okay. And think about it. So you can imagine that, let's say we have startups around us who hire a consultant and they say that I'm going to give you a stake in the company. Okay. I'm going to give you a 5% stake or a 1% stake or a 0.2% stake. So the moment they say I'm going to give you a stake in the company, it is not a fixed number of shares right now. If the company is going to, if that shares would be delivered after a certain point in time. Yes or no? Are you with me? So for example, there would be situations where a company says that, okay, I'm hiring you as a consultant, help me fundraise or help me do this accounting, etc., etc. Meanwhile, I am also doing my own transactions. I'm also doing my fundraise. And I'm going to give you a 5% stake in the company after a year. After a year. Then the number of shares is not fixed. If I'm saying I'm going to give you a 5% stake in the company today, the number of shares is fixed, right? I know my cap table. I know my 5%. So I know the number of shares I have to give them today. That's my obligation. It becomes an equity instrument. Okay. Second, a company enters into a contract to settle the obligation using its own shares at an amount that equals the contractual obligation. So I am entering into a transaction. I am saying that after this transaction is over, I will settle based on a value of the contractual obligation. So अगर 1 crore की service है, so I'm going to give you shares worth 1 crore. Is it an equity or a liability now? Second question. I'm going to give you shares worth 1 crore. I'm going to give you shares worth 1 crore, let's say after a year or whatever. Compound instruments is covered, sir. Yes, I am covering this today. I'm going to give you shares worth 1 crore. Yeah. Now see here, the answers are mixed. I see some people calling it as equity, some people calling it as liability. Yes. Yes, Chandrasekhar sir. Correct. You're right. Okay. I'm going to give you shares worth 1 crore, but this worth is not known today. I mean, I'm going to issue the shares after the contract is over, and I don't know what will be my value of security at that time. Okay. So remember, it is not the value of equity that you're committing that makes it an equity instrument. It is the number of shares, number of equity instruments that you would be giving that makes it equity instrument. Okay. So therefore, this becomes a financial liability. Everyone's okay with this? Yes. And as valuers, we're supposed to know this very well. Okay. Another example. Let's take one more example. A company issues CCPS and agrees to convert the CCPS into equity shares at a value equivalent to the time of conversion, equivalent to the value at the time of conversion. This is an easy one. We have discussed this already. Yeah, this is liability. This is clear liability. Okay, valuation would be done at the time of conversion. So therefore, it is not equity. And that is where, so I know a lot of us think that CCPS is the same as equity, right? In fact, even income tax 11 UA has mentioned that a CCPS should be valued in as if it is an equity instrument. But so let's face it, whenever a company is issuing CCPS and says that the conversion would be decided, the value of conversion would be decided at the time of conversion, right? So what happens to the investor? Is the investor's interest protected or is the investor's interest not protected?
Not protected.
Not protected, right?
Not
Because see
protected.
what happens, let's say my equity value today is 100. Okay, that's my equity value. Now I'm getting CCPS and I'm saying that after 3 years, I'm going to convert at then's equity value. So let's say that time equity value, assuming that business is going to go up, it is at 120, right? And if the person has given 1 crore, so if the conversion ratio is fixed, what happens? I divide that 1 crore with 100 and I know how many shares I'm going to get, 1 lakh. If I convert it after 3 years, I'm going to decide this then, right? But then I will still divide this 1 crore divided by 120, right? I'm going to get less than 1 lakh shares. So the CCPS holder has actually not participated, has not been allowed to participate in the value that has gone up, correct? So the interest is not protected. So on the other hand, it becomes a liability for the company also. So so this is what I do actually. When we see a company saying that we will determine the value, then essentially what they are trying to do is somebody has told them कि sir उस समय कराएंगे तो अभी valuation नहीं कराना पड़ेगा, right? You will be able to issue the CCPS at 10 rupees, and they want to save that nominal amount that they pay us as valuers. So I always tell them that sir, if you issue a CCPS today, it will appear like it is an equity instrument, but ultimately it is going to be a liability. Your debt equity ratio will change. Your capital structure will appear to have higher debt. Why do you want this? Right? Even if it is an Indian non-Ind AS company, if you're going to a bank, etc., they will consider the terms as a liability. So therefore, it's always advisable to have the conversion ratio fixed upfront in case of CCPS. Are we okay?
Because if a fixed number of conversion ratio fixed now, it will be shown as an equity in the capital share capital schedule.
Equity, yes, absolutely.
But shares are not
Absolutely.
issued.
Because then you know how many equity shares you will get, right?
Correct, but where it comes? Issued, subscribed, paid up capital, where it comes in the balance sheet?
No. So preference share comes separately. But again, so you will have subscribed capital equity shares, you will have subscribed capital preference shares.
Correct. Then this will it? I don't know. Will it become a subscribed capital because the shares will be issued after 2 years?
But it's subscribed capital in the form of preference shares. Later, the preference share will move into equity. Preference will become zero. Equity will go up.
So it comes as a part of preference share capital.
It will come as part of preference share capital. When I say whether it is treated as equity or a liability, I mean whether it is forming part of shareholders' funds or whether it is forming part of debt.
Agreed. Then if the number of fixed shares are fixed, it comes as a preference share capital. Once it is issued, it goes to equity share capital.
Yes. Now again, here's a word of caution. Yes, sir. So you're right. Exactly. That is how it is going to be done.
If the number of shares are not fixed, then it will be shown as a liability that level debt equity.
No, sir. Again, so that is what I want to clarify. So even if the company is not applying Ind AS, right, and the company has issued CCPS and the conversion ratio is going to be determined at the time of conversion, because Indian GAAP, I mean legacy accounting standards, does not require it to be classified as a debt. It will still show as preference shares. But any business person, any banker, any lender, any investor looking at your financial statement will be able to say that this is preference share, but effectively it is in the nature of debt. So they will adjust your debt equity ratio.
Thank you.
Vikash, I have one question.
Yes, ma'am.
Yeah, it's a very simple question. Like you said, in case of issue of CCPS, we determine the conversion ratio at the time of issue itself, okay? So that it falls under the equity classification.
Correct.
Practically, I just want to know, like, we have determined the conversion ratio by way of valuation report, but The CCPS are issued at that value, means I'm asking the value of CCPS, or they are issued at face values. Like it can be both ways.
Can always be issued at face value, ma'am. We already discussed that, right? We had that discussion initially. Yes, it can be issued at face value,
Because
no
we've
problem.
also seen that they will issue CCPS at the valuation what is arrived in the report. Suppose the value conversion value is one equity is valued at 2,300 rupees, example. So the one CCPS will also be valued at 2,300, so that
No,
that one is
not necessary. Not necessary.
not necessary. No, it can be
No.
both ways, right?
So see what will happen. Let's say this 1 crore, right? When we are talking about this 1 crore. So when it is CCPS, it will simply show 1 crore, right? But when it is converting into equity, what will happen? Let's say 100, right? So you will be issuing 1 lakh shares, 1 lakh into 10. So 10 lakh becomes your capital and 90 lakhs will go into your share premium. But this is when it will be converted. Your value is fixed today, right? There is no other change that is going to happen.
Correct.
Are you with me?
Yes, yes.
So when you are valuing the equity share and you are saying that the CCPS is issued at 10 rupees, the subject matter here is not what is the value of CCPS. The subject matter is that you have valued the equity share and you have fixed on the conversion rate. So the valuer's role is actually to fix the conversion rate based on the value of equity rather than determining what is the value of the preference share today.
Okay.
Okay. And that's what we will. So when I have a couple of examples. We have time till how much? 9:30, right?
Yeah, 9:30 maybe we can extend
Yes.
for 15
Yes,
minutes.
I mean,
it
the
is till
standard time is
9:30.
till 9:30. Okay.
Yes.
We have some time. So somebody was asking about compound instrument. We enter compound instrument. I have a couple of examples that I'm going to take, and then we'll open up to general discussion. Okay. So basically, compound instruments are what? These are instruments that contain elements of both equity and liability. Okay. And even if we were discussing a basic concept of a compulsorily convertible debenture, when we talk about the concept of Ind AS, even a compulsorily convertible debenture, it is a compound instrument, and we'll talk about that. Okay, here. So if a bond is convertible by the holder into a fixed number of ordinary shares, it is actually a compound instrument. From the perspective of equity, this contains two components. One is a financial liability and the second is an equity instrument. Okay. So basically, it is the same as issuing a debt with an early settlement provision and a warrant to purchase the ordinary shares. Okay. Let's take an example. Here's an example of a compulsorily convertible debenture. Okay. By the way, I must ask you this. It's 1 hour. Do you want a 5 minutes break right now?
We are
No.
good.
Continue.
We are
We
good.
good?
We are enjoying.
If you need a break, probably you
No,
can take.
once we take a break, it'll extend again. So better to continue morning, no?
Okay, sir. All right. Thank you for that. So the company has issued 20,000 compulsorily convertible debentures at a face value of 100 at par on, let's say, today, okay, 31st March. The coupon rate is 2%, and the convertible, and this is convertible after 4 years. Okay. Now, this is what typically what you will be getting from the company. Okay. When you get a CCD valuation engagement, typically this is what you will be getting. So the company would have normally decided that the face value is 100. We are issuing at par. They may issue at a discount or a premium also. So accordingly, that will be factored into valuation. And they will say that we have fixed a coupon rate of 2%. Okay. This will be convertible after 4 years. So these are the only things that the company will give you. What we need to do is we need to assess what is the risk-free rate, right? Everyone here knows how to calculate a risk-free rate. The important thing that we have to do in case of a CCD is to calculate the YTM. And this is where I think there is some confusion amongst the professionals. Okay. Because a lot of times people are discounting everything at 2%, which is not right. Now, why is the company giving a coupon of only 2%, first of all?
Equity value is embedded in it.
हाँ, but सर ये तो फाइनेंस की लैंग्वेज है ना. वो बिजनेस पर्सन को पता नहीं है कि इक्विटी वैल्यू एम्बेडेड है. वो बोला बाद में तो इक्विटी देंगे ना, तो अभी पैसे किस बात के देने हैं. वो तो सीधा सीधा ये बोल रहा है ना. तो
Correct.
और दूसरी बात है कि सी लुक एट इट, व्हेन द And let's look at the logic behind issuing CCD in the first place. CCD issue ही क्यों करना है? Why would we have to issue? Why would a company want to issue CCD in the first place? Think about it. The company wants to raise some funds, but the company does not want to dilute its equity today, and the company never wants to return that money. 3 conditions. Why any time a company would normally issue CCD? There may be more, but normally these are 3 primary conditions because of which it will be required. So company want to raise funds? Yes. Company does not want to give away any cash back, and immediate dilution नहीं चाहता है. Immediate नहीं चाहता. Ultimately तो चाहेगा, right? So what is happening here? That the main crux here is this 2%. Okay, this is the main crux. So what we will have to do? We have the risk-free rate, which is normally okay. Normally we have to take a premium on that, right? We have to calculate the YTM. So again, see here, if everyone knows how to calculate the yield to maturity normally, right? There is a yield to maturity formula. We have the redemption price, we have the current price, we have the coupon rate. The problem is we don't have a redemption price here. Correct? So therefore we don't call it yield to maturity. What the term that we call it is, we call it the redemption yield, right? Or the conversion yield, or basically the yield to the bond. So there what we do is we have to calculate that synthetic premium. So here you look at the credit rating. Now, what if the credit rating is not available? What will we do about it? What can we do if the credit rating is not available? In most cases, you won't find it, right?
So
Then what
typically we consider whether the company is a profit-making company, whether the company will be, will be able to, pay that interest on any part of it. And I generally take it as in the category of B. I'd never take it in the category of A plus or something.
Sir, but again, see, so what happens is whenever you have other people who are going to who will be, see, so I think, and when I come to talking about the option pricing, right, that's again, I will come to the same answer. But essentially what is happening, because the world is looking at taking observable inputs, right? So therefore it's going to be questionable to just take it at AA or B or triple B minus, etc. Okay.
I agree with you.
The easiest proxy is to calculate the synthetic rating, right? And everyone knows how to calculate synthetic rating, right? Just go to Damodaran, right? Are we okay with this? Everyone knows synthetic rating by Damodaran? Is there somebody who doesn't know? Please let me know. No? Okay. So let me show you that first. I'll keep this for the time being. The screen sharing has stopped, right? I must share the entire screen. Sorry, once again. It's very, very simple, right? You just search on Google and Damodaran synthetic rating opens up. You know, there's a page of Damodaran where all the Excel sheets are available.
Yes, sir.
You just look at Damodaran data sets and you will find that as well. Okay. But for now, I'll just show you the rating sheet. See here, it's very, very simple, right? But what Professor Aswath Damodaran has done is he's created this synthetic rating estimation. Now, see again, one good question, how is he coming up with this number? The point is that the world is using it. So now Damodaran is as good as a Bloomberg, right? You take that number and it's not questionable as such. So it says enter the type of firm, whether it is a large manufacturing firm or, sorry, here it is. So it says 3 categories: large manufacturing firms, smaller or riskier firms, or financial services firms, right? So let's say we are talking about a smaller or riskier firm. Now what you do is, does the company have any operating leases? Assume no. What you do is take the EBIT by interest. That's it. Calculate the interest coverage ratio. Okay. Calculate the interest coverage ratio. Everyone's okay with this? You know, you will get the EBIT versus the interest, right? Now here, you may have your assumption. You may take EBIT by interest after the issuance. You may take EBIT by interest before the issuance. Your interest coverage ratio will change significantly, but normally, practically speaking, those assumptions are working so far. Okay. Ideally, you should take it EBIT by interest after the issuance, but again, that would lead to a projection, which you may not have because you're only valuing the CCD or you're only valuing the bond. So therefore, you may take it before. Okay. So let's take for the timing, it's still 50 by 8, right? So you have your interest coverage ratio, which is 6.25. Okay. You enter the, our example, the risk-free rate was 7%, I guess, right? 7%. Yeah. So you enter 7% as the risk, but you don't need this anyway. So what you do is when you take the interest coverage ratio, it automatically gives you the bond rating. Are we all okay with this? Yeah. Give me a thumbs up. Tell me if is everyone okay with this so far?
Yes.
Yeah.
Actually, interest coverage has to compute, or this will be computed by the software itself?
It will be computed by this, sir. Sir, interest
Okay.
coverage ratio is simply EBIT by interest.
Yes, yes.
That's it. That's all it is. Okay. So when you have the interest coverage ratio, what Damodaran is doing is he is calculating the synthetic credit rating depending on the type of firm you are. It's very simple, sir. You see the interest coverage ratio is 6.25. We are talking about small firms. So where is 6.25 falling here? Right? 6 to 7.49 is A2. So this is A2 stroke A. This is where it is.
1.07.
Right? So don't worry about this for the time being, right? Because there is a problem with this. But what you can simply do is, and this is what at least we do, we calculate the synthetic credit rating of the bond based on this sheet. Okay? Everyone's okay with this? Everyone's okay with this?
Yes.
Yes.
Yes? Okay. So now what you can do is, ideally what you should be doing is so you have the credit rating. Let's get back to this example. So we have the credit rating of AA in this case. We have the FIMDA spread of 110 basis points. Now I heard a few people ask, from where do we get FIMDA spread? FIMDA spread is available only as a premium. So you have to subscribe to it, and it's
very costly.
Fairly costly. I think the lowest that you will get it is for
2 lakh
75,000 rupees a year.
2 lakh
Okay.
rupees per annum.
हाँ, so 2 lakh is for corporate, sir. आपको 75 में मिल जाएगा शायद, if I'm not wrong. Okay.
Yeah.
And trust me, you can sometimes get it from people. There are companies who have subscriptions to it. All you need is an Excel spreadsheet. Okay. So yeah, so you get the FIMDA spread. Now this is what is your yield calculation. What happens? You start with a risk-free rate of 7 and you add the credit default spread of 1.1%. So basically it gives you basis points. Now, if you have the FIMDA spread, that is considered to be the most appropriate in the Indian context, and it is the most acceptable format against or amongst all the larger firms. So there will be practically no question on this. Okay, practically no question on this. On the other hand, if you take an alternative, if you don't get FIMDA spread at all, you can still take Damodaran. You enter the long-term government bond rate like the way we've entered. Okay. And you take the bond rating and you use the same credit default spread that is coming from here. Okay. I must tell you the risk involved here. These estimated default spreads are based on a typical company in the US. Okay. It doesn't say anywhere in this spreadsheet, but Damodaran's all calculations, unless otherwise stated for a different country, is based on numbers which would be applicable in the US. Right? So my suggestion, if it's a simple transaction, if it's a small transaction, a big four audit firm is not involved, etc., and you don't have access to FIMDA, you can go by this. Nobody's questioning you on this. If it's a large transaction, large company, bigger auditor, right, riskier transaction, go by the FIMDA spread approach. Large firm would give you large fees. You can still afford a FIMDA spreadsheet, then go by FIMDA transactions. that will be most appropriate, because this may be questionable at some point, because the spread here is applicable to a matured country. So the country default spread is not built into the default spread that is mentioned here. Are we all okay on this? Everyone's okay with this? Ganesh sir, yes, go ahead, question. Sir, you can just unmute and talk, sir. Don't worry.
Okay. No,
Yes.
no, I didn't want to disturb the flow. That will be a problem.
Okay, go ahead, sir.
Sir, typically what happens is credit rating is a function of the new amount of debt or obligation one is going to undertake.
Correct.
If I were to take the existing debt and existing EBIT and based on that you do it, as you rightly said, you also said that it has to be post that. You said that.
Correct.
So
yes.
now how do I use Damodaran? Because end of the day, I'm getting the new obligation that I'm putting in. So for example, a company which has only EBIT which takes care of a 10 crores debt, it is taking a 100 crore CCD, for example, because it's a CCD, right? So that 100 crore comes as a new obligation. So how do I use Damodaran from with that angle? That's the question.
Sir, again, so there are assumptions, right? So here the assumption that you are taking is that the company's margin ratios, right, the return on capital employed or the interest coverage ratios, etc., would be maintained after the fundraise is happening. Because see, what is happening? Why is the company raising debt in the first place? The company would be raising debt to invest it somewhere in the business.
Correct.
So your assumption here is that the company will continue to maintain the same margins that it has maintained before that.
Only thing is, sir, if it is a traditional debt, I understand, because traditional people anyhow would look at regular interest coverage ratio and accordingly they will give a debt. There's no second thoughts. The concern was essentially in the complex instruments where the intention is equity, which is your compulsory convertible debentures or such kind. And today it is in the form of debt. And if that is the case, when you're valuing a debt, the reason why we come to synthetic rating is trying to determine what would be the underlying synthetic rating and correspondingly the cost.
Correct.
That's the underlying thought. Because
Correct.
on paper, CCD has only 2%, right? In order to determine that, I need to get into the, for example, if they're borrowing 100 crores, the one which was a A-rated in company before taking
It
the
will go down. Yes, you're right.
rated also. So that was my only concern. How would I use Damodaran for that?
No, sir. So whether you use FIMDA or you use Damodaran, in both cases the concern is same, right? Like I said, so we are sort of doing complex securities 101. Okay, as the complexity in the transaction also increases, you will also have to be more careful. So you're absolutely right. For a company which has an entire base of 1 crore is now raising 100 crore, the rating will never be the same. Now, if I have to justify what I'm doing, the justification comes from the fact that even the law requires you or suggests you to take those assumptions. For example, why are we even using this kind of a concept? Because FIMDA regulations, which is endorsed by RBI, which is also which is endorsed under FEMA, etc., are all saying, and even in SEBI in some cases, are all saying that when it's a convertible security, break it down into as if it was a non-convertible security. Right? So you make those assumptions. Now, frankly speaking, if I always try to go by that fairness concept. If I see that no, this makes the company very, very risky, I add an additional risk premium, for which I just call it a forecasting risk. I can't call it a liquidity risk. Because default spread is given by the regulators, it's given by a process. I don't want to be above the process, so therefore I can't call it default risk, etc. I add an additional premium if I feel that no, this is not justified. For example, a company like this, 8% is very low. They will not be able to raise funds at 8% given by this spreadsheet. I will add an additional risk premium always. Okay. So we try to explain this using the build-up approach, sir. But yes, I agree with you. That element of subjectivity remains in that process.
Is there a chart in India somewhere or any website, just the way Damodaran has given for various interest coverage?
FIMDA spread is there, no? So FIMDA spread gives you that chart.
Even for rating also is all there? No, I understood FIMDA spread is for default spread. So the way the rating, if your interest coverage, they say is 0.88, it is CCC.
No. So it's not there. Okay. So good point. See, so the first step that you should always do is check on the public platform whether the company has a rating or not.
Correct.
You should always check that. Whether the company is giving you this or not, you should still check that. Let me inform you one interesting thing if you're not aware. In India, earlier what used to happen, let's say the credit rating is at the option of the issuer, right? So let's say I am whatever, X Limited. I went to a credit rating company. I said, sir, मेरी debt की rating कर दीजिए. I have whatever exposure with the bank. I have 100 crore exposure with the bank. Give me a credit rating. the credit rating agency, let's say, gave me a rating of B minus. Let's say I did not like it. I'd say, okay, I'm withdrawing the application, right? And it would never be published. Now, the regulations are such where a credit rating agency will do whatever it has to do in terms of discussing with you what should be your rating, etc. It does that. But let's say the company says, no, we don't want this. It still is published under the unpublished rating category. Right? Because companies need to withdraw their rating. So the first thing you should always do is check on the public platform whether a rating is there or not. Even if it's an old rating, even if it's a withdrawn rating, try to get it. I have not found any similar sheet as compared to Damodaran where in a public platform you can give a rating. See, because then the whole concept of rating agencies will go away, right? So we'll still rely on this for the time.
One parameter, but it's a very valuable parameter. I would look at.
So of course, when you look at if you're talking about a credit rating agency, they will look at 100 parameters before giving a credit rating.
Correct.
This is a very simple and this is a very simplified version of it.
Yes, sir.
But it's working so far, right?
Thank you, sir. Yeah. Thank you.
So we've got the yield. Now see, what do you have to do now? You have to see the issue proceeds was 20 lakhs, right? To 20,000 into 100 into 100. Your coupon payments. Now see, this is the important part and everyone should focus here. What we have is our contractual payment is what? Only 2%. So I have the 2% payment, which I'll be making for 4 years. And then I will have a principal repayment. So again, all this would be minus. Then I have my principal repayment, which will be at the end of the year. So 4th year, I will make 20 lakh 40,000. I have a PV factor, right? So what I do is I take the present value of the redemption value, and I also take the present value of the coupon payments. Okay, let me put everything as mod, so it'll be easier to understand. Yeah. So the present value of the redemption value and the present value of coupon payment. So what are you discounting it at? The discounting is happening at 8.1%, which is our yield. What you get is a liability component, which is 15.96. How much did you get? 20. So 20 minus 15.96 goes into your equity component. Okay, we've had a lot of discussion during this example. Please take a moment and let me know if everyone is okay with this. Okay, so whenever you are valuing a CCD or whenever a company is issuing CCD, ideally this is how it is supposed to be. Let me complete that cycle, right? So your liability component is 15.96, your equity component is 4.03. So 4 lakh goes into your other equity today. 15.9. So how much amount of liability will you be recognizing? The amount of liability that you would be recognizing in your books is going to be 15.96. Even if you will be paying 40,000 rupees every year as your coupon payment, you will recognize a liability of 15.96. Now, this is the final part of it. So you recognize a liability of 15.96. This is my opening liability. You pay an interest at the rate of 8.1% on the liability. Okay. What you pay is 40,000. So your closing liability is 16.86. Next year, that becomes your opening liability. You pay an interest. You charge an interest of 1.36. Your payment is only 40. So your closing liability stands at 17.82. You see your liability is increasing. Until the end of 4th year, it will reach 20 lakhs. Please confirm if everyone's okay with this.
Yes.
Yes. Go ahead, sir.
So what is the definition here? We are saying 20,000 worth of CCDs you are going to get at the end of year 4, or it's at par?
Sorry?
Is it 20,000 rupees worth of?
20,000 CCDs, number of CCDs we are saying, sir.
Correct. The value you are referring to is 20,000 CCDs at the end of year 4.
Yes.
Yeah. So you are assuming that there is no equity value that it could have generated at the end of year 4. Suppose I reach year 4, I convert my CCDs equivalent to 20,000 equity shares. The value could be significantly higher.
That's fine, sir. So, okay, what we are doing here is the equity component. Okay, look at it this way, sir. When we are talking about CCD from an accounting standpoint, what is the value of equity share is not important in that case. It's completely irrelevant. From an accounting perspective, from an issuer's perspective, what is happening? I am saying that I am getting only 20,000 CCD. I am issuing 20,000 CCDs, getting 20 lakh rupees, correct? Against this 20 lakh rupees, I only have to pay 40,000 rupees for the next 4 years, each year.
So you're talking the books of the company who had issued.
Yeah, from the perspective of the issuer, yes.
Yeah. But recently we did some India's valuations.
Mm-hmm.
I was the auditor. I think they were not ready for this kind of a thing what you're referring to.
This is what is there, and sir, I am ex-EY.
No,
from an issuer's perspective, this is what it is.
No, you know it better than me. I'm not even questioning that. We had to value.
But it may be from an investor perspective, sir. That is different. I'm not valuing a financial asset here. I'm valuing a potential issuance.
No, in my case also it was a financial liability only in the books of the company. What happened is we had to do the valuation of the shares because they said it has to capture the fair market value as per Ind AS. Okay, so there is a liability of equity which has to be looked at it, and if that value is higher, how they put where in the accounting treatment I don't know, but we had to value the CCPS at a particular point of time. So every year we had to do a fair market value. So year 1, year 2, year 3, each year we were doing the fair value respectively. Based on the fair value that we are given as equity, that is what they have taken the CCD component, and correspondingly they made the accounting entries, which I am not familiar with. At least I'm just sharing what have my experience was.
Good point, sir. Let me reflect back on it. But so this is, I mean, as long as CCDs are concerned, this is a fairly established practice. It's you will find these concepts in public domain as well. And
see, the reason is that one of the reason is it's actually a liability that we are trying to establish for the company. The liability of the company is if I know that my liability of equity, if I'm giving away CCPS is nothing but, or CCDs is nothing but, I'm giving away equity, right?
Correct.
Fair value, which is much higher than the par value, right? So by just in the name of CCDs or CCPS, I try to give away at par. That is not a true reflection in the books of accounts. Principally, if I were to look at it, forget from the accounting side.
I get it. Yeah. So here we are not calculating the conversion ratio, sir. If you're looking at the conversion ratio as well, then of course you have to value equity also. No doubt. So
it's because it's a fair value as per India's definition. We were asked to do that. So I'm coming from that. Anyways.
No. So you're right. Okay. So I am only valuing the CCD in this case, right? What would be the value of CCD? And here, if you are engaged at all, your key part would be to value to assess the yield to maturity. Everything else is just accounting.
Okay.
Everything else is just accounting. If they are also asking you to determine the conversion ratio, which is always a possibility, then you always value the equity share as well and then calculate the conversion ratio.
Yeah. So what happened is they wanted me to value the fair value of CCPS and fair value of CCDs in their books. Okay.
Correct. So you're right. Okay. Correct. So here we are not talking about what would be the conversion ratio.
Understood.
Right. We are only saying that what will be the value of the liability component in my books of accounts. If they are also asking you to value the conversion ratio, it's very simple. You value the equity and you get the conversion ratio. Equity valuation, we are familiar, right? That's not a challenge anyway.
Yes.
Yeah. So what I was trying to explain here, which is usually not very common in the Indian GAAP context, is you have a liability in your books which is lower than the actual amount that you've raised. And this amount goes up to the final amount over the life of that security. Okay, so this is the key part that I wanted to highlight here. Okay, let's take a let's take a quick 5 minutes break. Let me resume in 5 minutes. I have a couple of things to address, right? Can I take a 5 minutes break?
Yes, sir.
Yes,
Yeah.
yes.
Just 5 minutes. Okay.
I would like to take this opportunity and make few announcements. As you all are aware, Bangalore Valuers Association needs a lot of volunteers. So I request you to volunteer for us. Please let us know your name. Give your name to me or Neela, so that your volunteering activities will help us to make certain new initiatives, new programs, or any such new ideas which we can consider for BVA. Mr. Vikas, I think this is the right time to launch the poll.
Yeah, sure. Let's do it.
Neela, can you launch the first poll?
Yes, ma'am.
Neela, wait for some time. Let all the participants give their votes. Wait for 1 more minute and share the results. And Mr. Vikas will give the answer. Okay?
Okay, ma'am.
I'm not giving the answer. I think the consensus will.
Meanwhile, the poll questions are on. The participants can raise queries and parallelly take Mr. Vikas' views.
Sure, sure.
Yeah, Neela,
Vikas,
stop.
can I ask a question?
Yeah,
Stop
yes,
at
go
10.
ahead, ma'am. And yeah, you can have the next poll question coming up as well. I think we can do all the questions now, I hope.
Yeah. Neela, stop.
Or maybe just do, we have 5 questions, right? Let's do 2 questions now or 3 questions now at least. Yes. Yes, ma'am. Go ahead, Vandana ji. Go ahead.
Yeah, this calculation that you had shown, should we do it even if the CCD is issued at 0.1% also?
Yeah, absolutely. In fact, you will see if the CCD is issued at 0.1%, the equity component will go up.
Correct, because the rate will be very less. Yeah.
Yes. So yes. In fact, if the CCD is issued at a coupon rate which is closer to the YTM, your equity value would be the lowest. So the coupon rate has a bearing on the equity component and the liability component. Therefore, you should do it in any case. Yes.
But do all companies do even if they issue at 0.1% also?
No, ma'am. Okay, good question again. So if it's an Indian company which is not subjected to Ind AS, this calculation is technically not required.
Correct,
It is only
correct.
required under Ind AS.
So in your experience? Have you seen companies do it even if they have issued at 0.1%?
Yeah. So you're talking about
Yes,
India's
yes.
companies, right?
India's company, yeah.
Of course, all of them will have to do it, ma'am.
Okay, thanks.
Otherwise, the auditor will not sign off on it.
Correct.
Vikashji, I have one question.
1 minute. Neela, launch the second question. Yeah, please go ahead.
Yeah, the table which you showed where you have calculated liability for each year. So how is it recorded in the financial statement? The closing liability will be recorded under CCD, is it? And the
Correct,
balance
yes.
will be recorded as equity.
Correct. So equity you've recorded upfront, right? 4,03,000 in our example was recorded at the time of issuance. In the first year, you are recording 15.96 as your liability and 4.03 as your equity. This liability component will increase to 20 lakhs, right? So at the end of first year, what will happen? 15.96 plus the accrued interest, because
20.
this amount you are not paying, right?
Yeah.
So that gets added to the liability amount minus 20,000 that you are already paying. So the net amount becomes your liability. That's what I had in my slide as well, right? So your liability amount will accrue on account of the interest that is being paid, that is being accrued but not paid.
Okay.
Let me show you this in an Excel. Let's answer this question on the poll and I'll quickly move to Excel.
Because just wild thought, equity doesn't have tax or whatever tax, and interest has tax deduction. Should that be considered while valuing these components? I'm just thinking loud. I have no answer.
So in my experience, as well as based on the literature, I saw your question in the chat. Based on the literature that we have followed, plus our practical experience of valuing multiple CCDs, we've not considered the tax impact of this because the security itself is not impacted by the tax. Security value would not be impacted. No. But it's a good point to consider. Honestly, I did not even think about it earlier. We'll give it a thought. But normally, we've seen whatever literature we have, India's guidance has not mentioned about it actually.
Yeah, incidentally, I didn't. When you presented that sheet, I'm thinking from that angle only, because eventually the value you are assigning, value is nothing but assigning between two parties. One is the seller and the buyer for an instrument. And the value is assigned purely from a post-tax impact, effectively. So there's an implication. So that's all I'm saying.
But here it will be different, right? Because here the value would not be the same for the issuer as well as the holder.
No, see, end of the day, when a balance sheet we are saying it's a true picture of the value of the instrument. So
I understand what you're saying, right?
Yeah.
Sorry, can you pull up the second question again? I don't remember, so I must answer what the first question was. 20 years, of course.
Anti-dilution 100 and next round is a bigger round. I'll share the results again.
Please. Okay, so a company raised equity funds with an anti-dilution clause at a valuation of 100 crores. Subsequently, it raised another round of funds with another set of investors at a valuation of 120 crores. So is the anti-dilution clause of the previous issue expected to be triggered? Think about it, right? So I am an investor. I have invested into the company and I have said that I'm entitled to a 5% stake in the company. Now the company has raised subsequent round. Now in the subsequent round, the value has gone up, but my stake percentage would have gone down, right? So if my stake percentage would have gone down, so normally it's actually a tricky question. Going by the question, the anti-dilution clause would be triggered. But normally what happens is this comes along with another right which says that I have the first right of refusal. If you're raising another round, ask me first. If I decline, then you go to the other investor. Otherwise, I will participate. We call it participating rights, if I'm not wrong. Yeah. So if that right is not there at all, participation rights, right? So if that clause is already there, then the anti-dilution will not trigger because I would have said no. But if that right is not there at all, then my anti-dilution would trigger and I would be entitled to more funds because my 5% has to be aligned with me. I must retain 5%. Right?
A different view of this. I thought if there is a down round of valuation.
So ma'am, that's down round protection. That's a different right.
Shall we launch the third question?
Let's do it. Yes.
Neela? Nila, you have any issues? Let me know.
We just solved this, right? Everyone should know this.
This question was supposed to be asked earlier before you explained.
No. So actually, all the questions were supposed to be asked at the end.
Basically, this is an IBBI way of checking that, all the participants, whoever have paid the fees and all, they actually participate and be, active during the session.
Yeah,
So when we do
definitely.
the CEP sessions with ICAI, they say that it's mandatory by IBBI to keep your cameras on. I don't know how
Same
far
with
that's true.
same with our PBI VPO. He says that the camera should be on because they send the recording to IBB.
Yeah.
Otherwise, they don't get the credit. So in PBI VPO, we won't get the credit if the camera is not on.
Yes.
Sir, see, we are
That is the
considered
rule.
so much. So please come to our CEP sessions.
No. I'm just now doubting what is the IBBI rule.
That is why
Okay.
we put that in the flyer.
All right. Okay. So let's
announcements.
resume, because I think I have a couple of more questions. I would like to quickly talk about them. I think that would be.
Can I
share the
ask a
results.
question?
Yes, sir. Please go ahead.
So while we were, we chalked out the value of the equity for accounting purposes. Once this conversion happens, I am wondering what would be the, what would be the calculations in terms of while the conversion price is being determined and the accounting part. Can we take another 2 to 3 minutes to dwell upon that?
Sorry, Vaibhav. Just let me quickly share my screen, and then maybe you can clarify exactly what you're looking for. Just a second, okay?
Mr. Vikas, can you just answer the poll so that
both debt and equity, ma'am. Both debt and equity.
Yeah.
Yes.
Okay. Neela, stop share and launch.
Yes,
another
Vaibhav.
poll.
Sorry, you were asking this question, right? Can you repeat, please?
Equity component is determined for the CCD part, right? 4,03,000. Now, once the conversion happens, what would be the next numbers that would come up in terms of price discovery and the accounting part, as far as the ETS is concerned?
Good. So I think what Ganeshji was referring to earlier was also that's going to be an extension of this. So I know that with respect to CCD, right? This is my redemption present value of the redemption amount. So this is my liability component basically at the time of issuance. By the time I reach my maturity period, my liability has gone up to 20. So 403 is already an equity. 20 is my liability. Now what happens when I convert? Okay. This 20 will be converted into equity. Okay. This 20. Is this part okay? Number one. Vaibhav, please stay with me.
Right. Yeah.
Now I don't know what is my conversion price.
Correct.
Right. This may be upfront or determined later. So let's say, assume that my price is ₹100.
Fine.
Okay. So number of equity shares will be what? Number of equity shares will be 20 divided by 100. 20,000. So my equity share capital, assuming my face value is only 10, is going to be very simple. 2 lakhs.
Correct.
Right? My share premium is now simple for me. I know this is going to be 20 minus share premium, 80. Is this what you're looking for, Vaibhav?
I was looking for this, but then what will happen to the equity component that's already accounted for?
ये तो चला गया ना already. It's already there. अब क्या होगा? Once something has gone into equity, nothing happens to it. It's part of the shareholder.
Okay. So
no change to this. That's the whole purpose of this entire calculation.
I have a
Okay, ma'am.
question.
Can we pause this? Let's do this towards the end, na?
I have a question. Hello.
I have a poll in front of me. I'm just requesting. Can we abandon this for now? Take it at the end.
Okay.
Just actually my request, same as Mr. Vikas. We'll finish the poll question and then
Okay, ma'am. All right. Let's answer. Gyan sir, please go ahead with your question.
I have a question. In this case, in a particular case, there is a conversion option, and which is the coupon is 2%. Suppose there is a no any conversion option, and company issue the coupon issue the debenture on the coupon it is 12%. Suppose same company also and different company also in a market, but now is a redemption yield is calculated here is a 8.1 in a some method apply. So we have a two option. We have a two data set in this case, 8.1% and 12%. So what would be the case we should take up?
Sir, sorry. So you are saying that the yield is 12% or you are saying the coupon is 12%?
Coupon is 12% without conversion option. Without
conversion option.
Yes.
Oh, so okay. So if it is, so we are talking about an NCD, sir, right? Let's take 8% for the time being. So, sir, then in that case, what will happen? See, your so let's take this poll thing. Okay. Meanwhile, sir, do answer the poll question, okay? And I will have to see that again because I'm solving this. I'm sorry.
So this is not a. Acha, is it shared? Acha, 1 minute.
Okay, everyone's answered this. Excellent. Yes. So yeah, Black-Scholes is the correct answer. PECV is capitalization of earnings method, right? So that is definitely a business valuation method or an equity valuation method. Black-Scholes is used for valuing options. So it's very commonly applied, but it's not the business valuation method.
Here, a small point, capitalization of earnings, whatever is the capitalization rate I take, is the analogy same as market approach wherein I give a premium or discount to the comparables? I do a market research. Can I apply the same analogy how I take a comparable company or comparable transaction, normalize it, and
not
then
required,
take
ma'am.
certain discounts?
So you can,
It can just
absolutely
be a
right.
rate.
No, ma'am. Okay.
So
So when we say capitalization rate, right? Capitalization rate is actually KE minus G. Sorry.
Okay.
Fundamentally speaking, capitalization rate is cost of equity minus the growth rate. It is very, very fundamental to the company. And of course, you can imagine that here KE would require you to calculate beta, and therefore you might have to look at the comparables and so on. Alternatively, capitalization rate is also connected to the PE multiple of the comparables, which is 1 by the EP. So that's you're right. We can take that. But normally you would look at the KE minus G.
That is, it can't be arbitrary.
It should not be arbitrary. No, ma'am. Yes. Okay. And if it's a, so, and normally speaking, just to extend on that, normally speaking, if we are applying the PECV method, it is usually going to be applied when we see that the company is not growing because you're looking at the average historical profits, right? So if it's average historical profit, generally G would be very nominal or zero. And therefore it is usually going to be same as equity, cost of equity. But yes, by definition, it should be KE minus G. Okay, let's take the last question and then we move into the discussion further. And Gyan sir, I will answer your question after this. Okay. As per the terms, the management is required to take approval from the investor for any expenditure above 15 lakhs. What type of rights are we talking about here?
Mr. Vikas, what's your plan to end the session at 9:30, or you plan for some extension 5-10 minutes?
I think we'll extend by 5-10 minutes. I have one example of OCD which I must cover, otherwise it will be slightly incomplete. So yes, I will cover one OCD example after this one. Might extend by 5-7 minutes.
I may not be there. Please guide our admin just in case.
No problem, ma'am. No problem.
Sir, one question. Can I ask?
Yes, sir. Go ahead.
In order to determine the conversion ratio, can only we have the option of the simulation technique, or can we go with other method also?
Sorry, sir. In order to determine the
Convert
conversion.
the
Okay.
conversion ratio. How can we
A
go
is the
ahead?
first. A is the right answer. Okay. Yes. Go ahead, sir. Sorry. Sanjay sir, go ahead. Sorry.
Yeah, just one question. To determine the conversion ratio, can only we have the option with the simulation technique, or do we have any other method to compute
Simulation तो
conversion
कर ही
ratio?
नहीं रहे. We are not doing any simulation here. Conversion ratio is just value of one security by the other security divided by the other security.
Okay.
ठीक है. So ज्ञान सर आपके वाले क्वेश्चन पे आ रहे हैं अभी, and then I move into OCD example, right?
Sir, Mr. Vikas, poll answer.
हाँ, affirmative rights. I answered A. A is the right answer. Affirmative.
We are done with all poll questions, no?
Yes, yes, yes.
Thank
So
you.
ज्ञान सर इसमें ना आपको क्या निकालना होगा? You will either have to determine the issue price or you will have to determine the redemption price, right? तो वहां पे you simply take the future value. So let's say यहाँ पे if we are calculating the redemption price, or let's say redemption is happening at par value,
Yeah.
right?
Yeah.
तो आपको क्या है ना, फिर आपको issue price निकालना पड़ेगा. So how will we calculate the issue price? You simply take the PV function, okay? Your rate will be the yield 8. So यहाँ पे क्या होगा ना, because you
No,
are paying
sir.
a very
I'm sorry. My question is different actually.
बोलिए
Suppose
सर, sorry.
company issue a bond or debenture, whatever you say.
Company
With
is issuing
option,
what? Sorry.
Company issued is a two category of the bonds. A is with conversion and B is without conversion.
So we'll have to take two separately, sir. Number one.
Yeah. Yeah.
Okay. So मैं आपको with conversion वाला तो हमने आंसर यहाँ पे डिस्कस कर लिया था.
Let me complete this.
हाँ हाँ. Okay.
Coupon rate is in the with conversion is 2%. And without conversion, coupon rate is company issued 12%.
Right. Okay.
Okay. And in the with conversion, my redemption yield is now is calculated here is 8.1%, which is used for the accounting purpose here. Liability and equity split into liability and equity.
Correct.
So I am taking here is 8.1%, but company issued without conversion debt is 12%. So in both it seems is a conflict in between the company's policies because everything is same except with and without conversion options.
Right. Okay. So you don't need a calculation. You need a discussion on this.
Yes,
I get it, sir.
yes.
So see when we are looking at 12% that the company is willing to pay, right?
Yes.
Now, how did we arrive at 8.1%? First of all, 8.1% is arrived at based on a methodology which we think is realistic towards the company's cost of borrowing.
Yes.
Ultimately, we are talking about the cost of borrowing. Okay.
Yes. Yes.
If I see that the company's actual cost of borrowing, so again, see, we always try to go by the rationality. When the company issues securities in the form of equity, then the company would want to reward the shareholders.
Yes.
But when a company takes a loan, it does not want to reward the lenders. Correct?
Yes.
So इसमें दो ही situation है sir. या तो आपका yield is 8.1% which is lower, या company का, so in that case you should take your yield at 12% because the company would have a basis of arriving at the 12% coupon, right? कंपनी के पास में 12% का कुछ तो बेसिस होना चाहिए ना सर.
12% is a market rate, which is generally
so market rate
issued by the
applicable to नहीं sir, market rate applicable to company. Understand? Because market rate would differ for companies to companies. If I go to a bank and raise 100 crore,
I'm talking about this company only.
हाँ.
Market rate.
So अगर market rate 12 ही है तो आपका ये 8.1% कम है. Then you have to apply an additional risk premium and take it to 12%. वो anomaly नहीं होनी चाहिए. If that's what your question is, then ये anomaly होनी नहीं चाहिए. Then the valuer should reassess whether 8.1% is appropriate or not.
My question
Definitely we
is
should.
there is without conversion option is coupon and yield rate is same basically.
Yield rate is same meaning
12% is the same without conversion option.
हाँ. Then आप okay. So I get your point, sir. I think when Ganesh ji and I were discussing, no, I think this is going back to that same concept. So ultimately this 8.1% should reflect the actual cost of borrowing for the company. So अगर कंपनी की actual cost of borrowing 12% के आसपास आ रही है तो आपका 8% गलत होगा, आपको उसको 12% तक ले जाना पड़ेगा सर।
ओके, नाउ गेट
ठीक
इट,
है,
नाउ
आई थिंक वही समझना चाह रहे थे ना।
यस 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 12% लेके जाना
ओके
पड़ेगा।
ओके, हाँ ठीक है
If I have
ठीक
the
है।
option of the without conversion in the company, so I should take the 12%.
Yes, yes, yes,
Rather
yes.
to calculate this method.
Correct.
Okay.
Absolutely, absolutely.
Yes, yes. Now I get it. Thank you.
ठीक है सर, thank you. Okay, so I have one example here. I will take about 5-7 minutes if everyone's okay with that. And I know some of you want to leave, so please leave. That's completely okay. I respect that as well. So here we have an example where a company is issuing an optionally convertible debenture. Okay, we are talking about a company which is issuing zero coupon optionally convertible debenture. Or it's not zero coupon actually. We've changed it to 0.1%. Okay. So the amount of fundraise is, let's say, 100 crores. Face value is 10 rupees per OCD. Coupon rate, we have fixed it at 0.1%. It could be 0%. That's fine. Conversion right is with the issuer. Okay. The issuer, the company. OCDs to be issued at par. Term to maturity is 5 years. I think we've still taken it at 5 years only. Term to maturity is 5 years. Now, what happens in these cases? The company will require you to assess a couple of things, maybe 3 things here. One, what should be the redemption amount? Because it is optionally convertible. So, agar ye redeem hoga, if it has to be redeemed, then what should be the premium at which it should be redeemed? Because the issue price is fixed, the coupon rate is fixed. Okay. Second, what should be the conversion ratio? In order to calculate the conversion ratio, you will have to calculate the cost of, you will have to calculate the equity value also. Okay. So these are two major things that we will have to assess. Are we okay? Third, because it's an optionally convertible debenture, you will have to still calculate the value of OCD. Okay. And that OCD value would be given by the standard debenture value, which is assuming it is not convertible, and you will add a option value to that. Are we okay with this part? Please use the chat window and quickly respond. Is it okay at this part?
Yes.
Yes. I'll repeat, Vandana ji. Okay. So when we are calculating a value of OCD, the value of OCD would be given by two components. One, the value of the debenture, assuming that this is non-convertible. And second, a value of the option which the company has to convert into the shares. So if the company has an option to convert debentures into shares, what kind of option are we talking about here? Is it a call option, put option for the company? It's a put option, right? It's a right to sell. Thank you. Right? So you will have to calculate the value of NCD, which is simple. You have to calculate the value of put, and then you add them together, you get the value of OCD. You also have the value of equity. The value of OCD versus the value of equity will give you the conversion ratio. Are we all okay with this? Please put the cursor on redemption value and value of OCD conversion. Devashish Das, sir, can you please unmute yourself? I'm sorry, I could not get your question.
Yeah, I want to see the formulas.
Sir, right now I'm in the PowerPoint presentation, sir. I'll move to Excel file quickly.
Okay. Thank you.
Okay. Okay. So what are we going to do here? Right. First, we are saying that we have raised 100 crores. Sorry, I've put everything into actual numbers, so that might sound a little confusing to you. But we've got the amount raised of 100 crores. The par value of OCD is 10. So I'm raising 10 crore OCDs, number of OCDs. The maturity years is 5. Coupon interest is 0.1%. And I have assumed that the equity share price is 300. We would have got this 300 using a DCF method if it's an unlisted company, or using the market price if it's a listed company. Okay. We've calculated the discount rate. The risk-free rate is 7. Spread per as per FIMDA guidelines is 1.09. As per our previous example, we are keeping the rate of OCD as, yield rate of OCD as 8.09. Okay. This part is okay with everybody. Please continue to say yes, no. I have to, we will be rushing a little bit, but I'm sure you will still be okay with what we are explaining.
Yes, sir. Yes.
Okay. Yeah. So I have calculated the discount rate. So this discount rate will solve our first question, where the company is saying that in case the company is going to redeem this at what premium it needs to redeem this. So 100 crore को 8.09 से compound करेंगे, adjusted for coupon, and I will get the value of OCD. Okay. So here, what will be my redemption value? My redemption value, I have got 100 crores, coupon is 0.1, coupon interest is 10 lakhs, 100 crore into 0.1. Maturity years is 5, discount rate is 8.09. I simply use the future value formula and I calculate the redemption value. Are we okay with this? Yes. आपको, you would know कहाँ पे plus minus लगाना है, right? So I'm not focused on that. You know, I'm explaining more focused on the concept as of now. So once I have got my redemption value, right? What will be my present value of OCD? And again, you see, we have to double count it here. My issue price is fixed at 10, but I still need to calculate the present value of OCD again now. Okay? Because my present value of OCD may not be same. It may be different, and it may be different because of my coupon rate. Okay? So let's say, because here you see my redemption value is 146. My present value of OCD is 9996, which is the same as 100 crores almost. Divide by the number of OCDs, I get a value of 10. But just to explain to you, this is arriving at 10, but this is not necessarily going to be 10 always. Okay. So let's say if my coupon interest was, let's say 5%, this value would be 9.84. Are you with me? Okay. So this is approximately 10. It's not actually 10. Okay. So we have got the first component, which is the value of the OCD assuming no conversion. That's my first part. Here comes a little bit of a complication. Okay. We have to calculate the value of the put option. So we said the underlying asset value is 300. We have calculated the value of equity at 300. We have said the exercise price is 50. So this OCD is subject to exercise. Now see again, when this, so this is an optionally convertible debenture. So at the time of conversion, the company will require the OCD holder to pay some amount. This some amount could be face value also, right? This could be face value also. It could be a higher amount also. Again, that will be given to you by the management. I have deliberately taken a higher amount. In practically all cases, you will find it to be the same as the face value. I've deliberately kept a higher amount because otherwise ये value घूम फिर के 10 ही आ जाता. ठीक है? Risk-free rate annualized 7%. Standard deviation. Now, how would you take the standard deviation here? Right? I have taken metal index, or you could take the peer companies as well. Okay. Now, when you take peer companies, usually there is a debate whether this peer company is actually peer or not, whether it is realistic or not, etc. Again, going by the literature, you should look at what are the peer companies. In case you find that the companies are actually small, then we can take the small cap index if your industry is not aligned. Here, we have, in some cases, we have taken the industry index standard deviation, right? So normally we reduce the amount of back and forth if you take a broader index, because the anomalies are eliminated. Everyone's okay with this? Yes, please give me a thumbs up. Give me yes if you're okay with this so far. Standard deviation क्या लेंगे, है ना?
Yes.
So ये हो गया. इसके बाद में टाइम हमको पता है 5 साल है. You apply the Black-Scholes formula. I'm sure everybody would have access to a Black-Scholes spreadsheet. It's easily available in public domains. Okay. So here we don't have to value the call option. That's not required. We are valuing the put option. Okay. So only because I changed the exercise price to a higher amount of 50, I have the put option value. So क्या हुआ? My value of OCD is value of OCD assuming no conversion, value of option, which is the put option. So you add this, you get the put option value. Okay, which is about 10.84. Your equity value is 300. We have already decided this. So my conversion ratio would be 10.84 divided by 300. You multiply this in 2000. So for every 1000 OCD, you will be getting 36 equity shares. Okay. So you have 10 crore OCDs against which you will be issuing 36 lakhs 14,000 equity shares. Take a pause, take a look. Let me know if you have any questions. Okay. So normally we would go a step further to validate our workings, for which I'm sorry, we will not have time today. But normally we would go a step and validate. So what we try to see is that are the OCD holders getting a value which is equivalent to the value of equity, right? But again, it's a fairly complicated exercise, but sometimes it could be done. So what would be the best rate to consider in case from Sir Rajiv sir, I mentioned, right? You can still use Damodaran, but there you would realize that ultimately you would have to take an additional risk premium in most cases because it might appear to be a little lower. There is another way you can add a country risk premium. So Damodaran spreadsheets, there is a separate spreadsheet where you can get the country risk premium, right? You may want to add that. So if you add country risk premium and the credit spread which is given by the Damodaran's file, normally you should be okay if you don't have HIMD access. But I would sincerely request you to not just put arbitrary numbers because increasingly those will be questioned. I mean, I sit on the valuation standard board of ICAI. This is my 3rd year there. And we are constantly trying to align the valuation practices with global practices. And we are always saying that let's reduce the number of subjectivities that we have, right? So as we go along, I know that the practitioners would be looking at more objective calculations, even if they are assumptions. Yeah. Now, I want to end on
just one question.
Sir, go ahead. Yes.
Yeah, sometimes in the agreement, the tenure is not specified. In this case, you have taken 5 years, so it's maximum tenure of 20 years. There is no specific tenure. So in both your examples for CCD and OCD, should it be a management assumption in that case?
No, sir. So it should not be a management assumption. The tenure should be there, right? But I'll tell you how it is sometimes mentioned. So normally we have two more rows that we add here. Okay. One is the vesting period and second is the exercise period. So ये कह रहा है कि let's say 3 साल तक तो कुछ नहीं होगा और 3 साल के बाद में 5 साल तक एक्सरसाइज कर सकते हैं.
Okay.
Sujan ji, right? So normally
Yes.
that should be mentioned. It should not be an infinite period. Because if you say infinite period, because if it is infinite, then you will have to actually take a different number. You can't just take 5 years then. So time until expiration is going to be a period, which can be the minimum periods, which is, let's say, it says that for the first 3 years, there's a lock-in. So you can't do anything in the first 3 years. And then after the first 3 years, you can exercise up to, let's say, another 3 years. So then you will take 6 years here.
Understood.
Right? So should not be arbitrary for sure. Right? Now, a couple of things that we should keep in mind, and I'm trying to do that argument with some people. I know it's futile as of now. What happens is, think about it. If you look at the literature of how the BSM model was designed in the first place, Black-Scholes model was designed to value options which had a very small life, maximum 3 months, right? Because the standard deviation that it used to take was real-time volatility. अभी हम लोग क्या कर रहे हैं? हम लोग इसको एक 5 साल के या 10 साल के सिक्योरिटी में we are valuing, applying a Black-Scholes model to value a security which has a life of 5 years, right? The model itself was not designed to capture such a security. So our assumption of standard deviation is actually not realistic because BSM was created to take the standard deviation of the security that you are valuing. We are saying that we don't have a security that we are valuing. So let's take comparables. Now, how can you take a comparable security? And now again, look at what the regulators are asking us to do now, right? They are saying when you are valuing a private company, take the comparable listed company. A comparable listed company cannot have the same volatility as the private company, right? And there is no way you can adjust it. So यहाँ तो फिर भी ठीक है. We know it's a clear option. I mean, I am personally not in favor of the concept of backsolve methods, etc., which is normally discussed, right? Because I think we are going too overboard. We are overrating the Black-Scholes model particularly, right? So although we have to apply it at some points, but let's look at the underlying assumptions of these models and then see whether it is actually applicable or not. But that's a personal view, right? I know it's sort of contrary to what a lot of professionals believe, but I thought I must mention this because we're talking about this subject. So yes, that's about it from my side. If you still have questions, I'm happy to address them for the next couple of minutes, and then we'll have to quickly wrap up, please. Yes, if the right to convert with the holder, then you would have written a call option. Yes, you have an obligation to sell. Okay, so I think that's about it. Thank you very much.
I have a question.
Yes, sir. Go ahead, please.
Sir, can you please conclude OCDs and CCDs from the perspective of the compliance perspective with regards to valuation, quoting a specific section from the Companies Act?
See, so whenever if you're talking purely from a Companies Act perspective, debentures fall under section 71, and then there's going to be I think it's going to be private placement, so section 42. So 42 and 71 read with company shares and debenture rules normally.
Okay, so it goes for both OCDs and CCDs.
So Companies Act does not discriminate between a convertible debenture versus a non-convertible debenture or optionally convertible debenture. It simply says debenture.
So as far as the Companies Act is concerned, we have to issue a valuation report while.
हाँ सर, काम मिल रहा है, क्यों छुड़वा?
नहीं बिल्कुल.
Yes. Okay.
Perfect. Great session,
right.
Sir.
Thank you very much. I hope I was able to add some value. I will definitely share the PPT Excel. Let me see. I'll have to clean up a little bit because it has got some other scribbles as well. I'll try to share. We'll do that. Okay. Yes.
Thanks, Vikas.
Thank you very much.
Vikas, can you share the Excel sheet examples?
Sir, I will. I'll have to clean up that a little bit because there are some external links to it. It comes from our tool. There are some cell namings. I'll clean it up and I'll share, sir. You will be able to figure out some things.
And also
sure.
the OCD, what you last,
I will. Yes.
Yeah, that will be great. Helpful.
Yes. Thank you.
Thank you. Thanks a lot, Vikas. Really enjoyed.
Thank you, sir. Thank you. Bye-bye. Can I just switch off, ma'am? Yeah.
1 minute.
Yes, sir. Go ahead, sir.
Today we have got a wonderful session, and everybody has attended with a lot of enthusiasm and attention. I observed that today's attendance is as high as 55. So off late, post-COVID, the attendance has dwindled a lot because everybody is busy with their practice and or having other commitments, etc. Though it is a Saturday, the attendance has been dwindling, despite the fact that there's a many good speakers were there earlier, or many good topics were covered in those webinars. But today, as I have observed, that it is 54. It is a very good attendance, and thanks, Mr. Vikas, for kindling such interest among the participants and clarifying their doubts. And many of the participants have actively participated in the deliberations and got their doubts cleared. And it is helpful not only to them, even to other participants who have got similar doubts. And without repetition, you have got cleared all the common doubts which are in the minds of all the values. And it will come a handy tool for all of us. And you have patiently covered the requirements of evaluation of convertible securities, why we should do that, then why there need not be a valuation report in certain cases, then what is the financial impact, what's the financial liability, then financial liability when it happens, when it is a financial liability, when it is an equity, what are the differences between these two, how do we categorize them, then what are the compound instruments, then say for most of us synthetic rating is new to us, including me. Say it is now for the first time we are hearing how what is synthetic rating, how it is calculated, and you have given the clue as to how to find it by referring to Damodaran's website, and you have given a very good what do you call enlightenment regarding that. Then how to calculate the FIMTA rating, how do you find it, and what are the alternatives when we are not able to get it, or when we cannot afford to subscribe to FIMTA rating, etc. Then country-wide risk premium also you have covered, and you have covered evaluation of OCDs, etc. And I think only some of the items which were covered in the flyer could not be covered due to paucity of time, like valuation of reserves, etc. I think we'll have another opportunity to hear from you to cover the remaining topics which could not be covered due to paucity of time. I thank Mr. Vikash for taking this wonderful session that say people have shared even now, say despite their personal commitments to attend their offices, etc. And thank you all participants without whose part of the active participation. The webinar should not have had value, this much of value. And also I thank the BVA who has arranged this wonderful session. And in future also we have such type of wonderful sessions. And as already our president Shilpa has informed that to say we have one seminar on 3rd August 2024 at Bangalore. I request every one of you to join that, participate it, and I also request members to canvas about the BVA and request your friends and those interested non-valuers or non-qualified valuers who have got interest in valuation to join this organization and spread the message about them and be benefited. And as a token of our gratitude and respect for you, Mr. Vikash, this memento will be couriered to you very soon. Thank you.
Thank you very much, sir. That's a wonderful gesture from your side. Thank you.
It is our pleasure.
And I must thank Shilpa ji for this, because she's been we've been in touch for a long time, and we were talking about this session since some time. So actually the credit goes to her, because she was pushing to cover some of those topics, and I missed the session earlier as well. So once again, apologies for that. But yes, a lot of credit goes to her for ensuring that BVA is organizing the right kind of topics for its members. So thank you to her specifically, and then of course the entire team. I'm in touch with some of you, so yeah, thank you very much.
On behalf of all the participants, I request you to share the presentation and Excel wherever possible with
I will, yes.
modifications or deletions, etc., so that everybody will be benefited.
I will. Okay.
Good day. We'll be concluding.
Thank you. Thank you very much. Take care. Bye-bye.